What if I told you the financial advice you've been fed your entire life, work hard, save 10%, pay your taxes, is actually a trap designed to keep you middle class forever? While you're stressing over TurboTax, wondering if you can write off your home office or if you saved enough receipts for your charitable donations, the ultra-wealthy are operating in a completely different dimension. They aren't just finding better deductions, they are fundamentally restructuring where and how their money exists to make it invisible to the IRS. I'm not talking about buying a yacht to write it off as a business expense or stuffing cash into a mattress. I'm talking about a sophisticated, perfectly legal triad of maneuvering that turns high income into ghost wealth. It's a system I call earn, hide, grow. And once you see it, you'll realize why the gap between the 1% and everyone else isn't just a gap, it's a canyon that's being widened by the tax code itself. My name is Peter Lewis, and on this channel we dissect the financial playbooks that Wall Street and the elite don't want you to read. If you are sick of seeing your paycheck decimated by taxes while headlines scream about billionaires paying zero, you need to smash that subscribe button and like this video. Because today we are going to break the matrix. We are going deeper than the standard buy, borrow, die advice you might have heard. We are looking at the active management side of wealth hoarding, the active restructuring of income that makes tax bills disappear before they even arrive. Most people think tax avoidance is about what happens after you make money. You earn $100,000 and then you try to find deductions to lower the bill. That is rookie thinking. The earn, hide, grow strategy flips the script. It attacks the tax problem before the money ever hits your personal bank account. It's based on a simple premise. You are the most heavily taxed entity in the economy. Individuals pay the highest rates. Corporations, trusts, and insurance vehicles, they pay far less or sometimes nothing at all. So the wealthy simply stop being individuals in the eyes of the IRS. To understand this, we have to go back to the very foundation of the American tax system. It was designed in an era where income was straightforward. You worked, you got paid. But as finance evolved, the wealthy realized that being a W-2 employee is financial suicide. When you are an employee, the government has first dibs on your money. They take their cut, federal tax, state tax, FICA, Medicare, before you even touch a cent. You are left trying to build wealth with 60 or 70 cents on the dollar. It is mathematically inefficient. The wealthy do not accept this inefficiency. They play a different game entirely. Let's start with phase 1, earn, but not earning like you and I do. The wealthy never ever accept high income as a W-2 individual if they can help it. Instead, they funnel their earning power through entities. This is the first great filter. Imagine a high-paid consultant, a specialized surgeon, or a business owner. Let's call him David. If David takes a $2 million salary, he is getting crushed. He's in the top bracket, paying 37% federal, plus state taxes, plus everything else. He might lose $900,000 right off the top. So David doesn't take a salary. David sets up a C corporation or a complex LLC structure in a tax-friendly jurisdiction, maybe Delaware, maybe Nevada, or if they're really big, Ireland. The money flows into the company, not the person. Why does this matter? Because a corporation pays taxes on profits, not revenue. An individual is taxed on revenue. The corporation can spend money on business expenses before the tax bill is calculated. Now, you might think, okay, business expenses, I know that, but you don't know the scale. For a corporation, almost anything can be a business expense if justified correctly. That luxury car, it's a company vehicle used for client meetings. That trip to Aspen, it's a board meeting or a strategic retreat. The high-end dinners, the electronics, the home office upgrades, these are all operational costs. By the time David's corporation is done spending, the taxable profit is significantly lower than the $2 million that came in. But the real kicker in the earn phase, the nuclear weapon of tax avoidance that almost nobody talks about, is the Qualified Small Business Stock, or QSBS, exemption.
This is Section 1202 of the tax code. It was introduced to encourage investment in small businesses, but it has become a massive loophole for founders and early investors. Here's how it works. If you structure your company as a C corporation from day one and you hold the stock for at least 5 years, when you sell that stock, you can exclude up to 100% of the capital gains from federal taxes. The limit is the greater of $10 million or 10 times your initial basis. Let that sink in. You start a company, you put in a little bit of money, you work hard, you build it up. 5 years later, you sell it for $10 million. If you were a regular investor selling stocks, you'd pay 20% capital gains tax plus the net investment income. That's millions of dollars gone. But with QSBS, you pay zero federal tax, nothing. You walk away with the full $10 million. And sophisticated investors know how to multiply this. It's called stacking. If you have a spouse, you can gift them shares, and they might get their own $10 million exemption. If you have trusts for your kids, each trust might be able to claim its own exemption. There have been cases where founders have shielded $40 or $50 million completely tax-free by using multiple trusts to stack QSBS exemptions. This is the earn phase, shifting the income recipient from you to an entity you control, and then using the specific rules of that entity to wipe out the tax liability entirely. Now you've earned the money inside a corporate shell, or you've sold your business tax-free, but you need to manage that wealth. You can't just let it sit there. And if you invest it in a regular brokerage account, you start generating dividends and interest, which are taxable. This brings us to Phase 2, hide. This sounds illegal, like we are talking about Swiss bank accounts and shell companies in the Caymans. While those still exist, the modern wealthy prefer something domestic, compliant, and infinitely more powerful. It's the most boring, heavily regulated industry in the world, insurance. Specifically, we are talking about private placement life insurance, or PPLI. This is the super-rich version of a Roth IRA on steroids, with no contribution limits and investment flexibility that would make your head spin. Here's the context. Life insurance enjoys special tax privileges in the United States. The cash value inside a life insurance policy grows tax-deferred. If you access it correctly, it can be tax-free. The government allows this because they want people to have life insurance, but the wealthy twisted this rule. They realized that if they stripped away the insurance part to the bare legal minimum, just enough death benefit to qualify as insurance, and maximized the investment part, they could create a massive tax shelter.
So here's how it works. You take that money sitting in your corporation or your trust, let's say $10 million, and you dump it into a massive, customized PPLI policy. To the outside world and to the IRS, this money is now a premium paid into a life insurance contract. It's gone. It's an expense. But inside the policy, that cash isn't just sitting there. It's being invested. And unlike a normal whole life policy where you are stuck with the insurance company's mediocre returns, PPLI allows you to choose your own investment managers. You can invest in hedge funds, credit funds, real estate, private equity, or high-growth stocks. Here is the magic trick. Because the investments are technically inside an insurance policy, they grow tax-free. Let's say you invest in a hedge fund that generates short-term capital gains. Normally, those are taxed at the highest ordinary income rate, 37% plus state tax. It's brutal. But inside the PPLI wrapper, zero tax. Let's say you invest in a bond fund that kicks off interest income, normally fully taxable. Inside the wrapper, zero tax. You can have $50 million compounding at 10 or 15% a year, generating millions in gains annually, and you don't even have to report it on your tax return. It's hidden inside the insurance wrapper. There are no 1099s generated for the activity inside the policy. It is an invisible vault. And unlike a 401k or an IRA, the government doesn't tell you when you can touch it.
There are no required minimum distributions. You don't have to wait until you are 59 and a half. So how do you spend the money? You can access the cash value of the policy through, you guessed it, tax-free loans against the policy itself. You borrow your own money back from the insurance company. The loan is not income, so it's not taxed. You pay a small interest rate, but often that interest is paid back into your own policy, so you are effectively paying yourself. It creates a cloak of invisibility around your compounding wealth. The wealthy aren't hiding money in suitcases, they're hiding it in contracts. The scale of this is enormous. We are talking about billions of dollars currently sitting in PPLI structures. It is a favorite tool of hedge fund managers, family offices, and ultra-high net worth individuals who generate tax-inefficient income. If you run a strategy that makes 20% a year but churns the portfolio constantly, taxes would eat half your returns. Put that same strategy inside PPLI, and you keep it all. Finally, we hit Phase 3, grow, but specifically growing wealth while shrinking its value in the eyes of the taxman. This is the dark art of valuation discounts. This is where the strategy moves from income tax avoidance to estate and gift tax avoidance. In the United States, if you are successful enough, the government imposes a 40% tax on everything you try to pass to your children over a certain exemption amount. For the ultra-wealthy, this is the biggest threat to dynastic wealth. If every generation loses 40%, the fortune evaporates. So they use a technique that effectively lies about the value of their money, with the IRS's blessing. This involves family limited partnerships, or FLPs. Let's say you have built a massive pile of assets, real estate, stocks, private businesses. It's worth $100 million. If you just give that to your kids, you get hit with a massive gift tax bill. The government wants their share of the transfer. So the wealthy take that $100 million portfolio and put it into a family limited partnership. They take back two types of interests: general partner interests, which control the partnership, and limited partner interests, which have no control. Then they give the limited partner shares to their heirs or to trusts for their heirs. But here's the trick. They hire a professional appraiser to value those shares. The appraiser looks at the shares and says, well, these shares represent ownership in the partnership, but the person holding them can't sell them easily because there is no public market for them, and they can't make any decisions because they have no voting power. Therefore, these shares are less valuable than the underlying assets. This is called the lack of marketability discount and the lack of control discount. The appraiser might conclude that although the shares represent $1 million of underlying assets, the shares themselves are only worth $600,000 on the open market. Suddenly, $100 million of wealth is valued at $60 million for tax purposes. They just vaporized $40 million of taxable value out of thin air. The assets inside the partnership haven't changed. The real estate is still the same real estate, the stocks are still the same stocks, but for the purpose of the gift tax, 40% of the value has disappeared. This allows the wealthy to transfer huge amounts of wealth to the next generation without triggering the tax that is supposed to catch it. And once the assets are in the kids' names or their trusts, all future growth happens outside of the parents' estate. It gets crazier with things like grantor retained annuity trusts, or GRATs. This is a tool famously used by tech billionaires like Mark Zuckerberg and the founders of Google. Here's how a GRAT works. You put a high-growth asset, like pre-IPO stock or a volatile tech stock, into a trust for a short period, say 2 years. The trust is set up to pay you back an annuity equal to the initial value of the assets, plus a tiny interest rate set by the IRS, called the Section 7520 rate. Mathematically, the IRS calculates the value of the gift to your kids as the remaining value in the trust after you get your annuity payments. Since you are scheduled to get back everything you put in plus interest, the calculated value of the gift is theoretically zero. But the reality is, if the stock explodes in value, say it goes up 1,000%, the trust pays you back your initial investment plus the tiny interest, and all that excess growth, that massive windfall, passes to your kids tax-free. If the stock doesn't go up, you just get your stock back and you're out a few dollars in legal fees. It's a heads I win, tails we break even bet against the IRS. You can do this over and over again. These are called rolling grats. You keep rolling the dice until you hit a winner, and when you do, massive amounts of wealth transfer to the next generation, completely free of gift tax. You are literally growing wealth in a zone the IRS radar cannot see. Let's look at a detailed hypothetical case study to see how this trilogy, earn, hide, grow, plays out over a lifetime. Let's invent a character named Marcus. Marcus is a software engineer who has an idea for a new AI platform. He knows the game. He doesn't just start coding, he starts structuring.
Phase 1. Earn. Marcus incorporates his new venture as a C corporation in Delaware. He issues himself 10 million shares of stock for a fraction of a penny each. He files an 83B election with the IRS, which tells them, "I'm paying tax on the value of these shares now." Since the value is basically zero, the tax is zero. This starts the clock on his QSBS 5-year holding period. Marcus also sets up a Roth IRA, but he doesn't buy mutual funds. He uses a self-directed Roth IRA to buy some of the founder's shares in his own company. This is a move made famous by Peter Thiel. The company takes off. 5 years later, Marcus is ready to sell a portion of the company to a private equity firm. The valuation is sky high. He sells $10 million worth of stock held personally. Because it is QSBS stock and he held it for 5 years, that $10 million hits his bank account completely tax-free. He saves over $2 million in federal taxes right there. The shares in his Roth IRA? They are now worth $5 million. Since they are in a Roth, that growth is tax-free forever. He can't touch it yet without penalty, but it's a tax-free pot of gold waiting for his retirement. Phase 2. Hide. Marcus now has $10 million of cash and a high net worth. He doesn't want to pay taxes on the income this cash will generate. He takes $5 million and sets up a private placement life insurance policy. He works with a specialized broker to structure it. Inside the policy, he directs the investments into a high-yield credit fund that pays 12% annual interest. Normally, this interest would be taxed as ordinary income, 37%. But inside the PPLI, it compounds tax-free. Over the next 10 years, that $5 million in the PPLI grows to $15 million. Marcus wants to buy a vacation home in Hawaii for $8 million. He doesn't sell assets and pay capital gains. He calls the insurance company and requests a loan against his cash value. They wire him $8 million. This is not a taxable event. He buys the house. The remaining $7 million in the policy continues to grow and compound, likely covering the interest costs of the loan. He has accessed his wealth without realizing income. Phase 3. Grow. Marcus is now in his 60s. His remaining stake in the AI company, his real estate, and his other investments have ballooned to $200 million. He is looking at a potential $80 million estate tax bill if he dies. He sets up a family limited partnership. He transfers $100 million of commercial real estate into the FLP. He retains the general partner interest, 1%, and gives the limited partner interest, 99%, to a trust for his children.
He hires a top-tier valuation firm. They argue that because the family cannot easily sell the real estate, and because the limited partners have no say in the management, the 99% interest is subject to a 35% valuation discount. So, instead of reporting a $99 million gift, he reports a $64 million gift. He uses his lifetime gift tax exemption, which is currently historically high, to cover a chunk of this and pays a small amount of gift tax on the rest. He has effectively transferred $35 million of value tax-free. Furthermore, he sets up a GRAT with some volatile tech stocks he owns. He puts $10 million of stock into a 2-year GRAT. The stock doubles in year 1. At the end of year 2, the trust pays him back his initial $10 million plus interest. The remaining $10 million of profit goes to his kids' trust, free of gift tax. By the time Marcus passes away, he has successfully moved the vast majority of his wealth out of his taxable estate. His heirs inherit a massive fortune, largely free of the 40% death tax. The dynasty is secure. The result? Marcus lived a billionaire lifestyle, accessed millions in liquidity, and passed down a dynasty, all while paying an effective tax rate lower than his executive assistant. And this is why the system feels broken. It is designed to be modular. If you are a W-2 employee, you are a monolithic block of taxable meat. You can't break yourself apart. You are one person, one tax ID, one liability. But capital is fluid. The wealthy treat their money like water. It flows into the cracks where the taxman can't reach. They use the complexity of the code as a shield. They fragment their wealth into different legal entities, corporations, LLCs, trusts, partnerships. Each of these entities has its own rules, its own deductions, and its own tax rates. By moving money between these entities, they can arbitrate the tax code. Every time you hear a politician talk about raising rates, remember Marcus. Raising the income tax rate to 50 or 60% doesn't hurt Marcus because Marcus doesn't have income in the traditional sense. He has loans, he has insurance cash value, he has unrealized capital gains inside a trust, he has return of capital distributions. Raising rates on W-2 income is like trying to stop a flood with a chain-link fence. The water just goes right through. To truly tax the wealthy, you would have to fundamentally change the definitions of income and realization, which would require rewriting the entire tax code from scratch, something that is politically almost impossible. This strategy, earn via entities, hide via insurance, grow via discounts, creates a gravitational pull that sucks wealth upward and keeps it there. It explains why we have families in America that have been dynasties for 100 years, the Rockefellers, the Mellons, the DuPonts, while 70% of middle-class families lose their wealth by the second generation. The middle class pays taxes that erode their compound interest. The wealthy have removed the friction of taxation from their flywheel. When you pay 30% every year on your gains, your wealth compounds much, much slower than someone paying 0%. Over 30 or 40 years, that difference is not just double, it is exponential. It is the difference between retiring with $2 million and retiring with $20 million. So, what do you do with this information? It's easy to get angry. It's easy to feel defeated. But anger doesn't build wealth. Understanding the rules does. You probably can't set up a PPLI policy tomorrow. The minimums are usually high, often requiring at least $2 to $5 million to start. But you can stop thinking like a W-2 employee. You can start looking at the world through the lens of entities. You can start a business, even a side hustle. This opens the door to the earn phase benefits. Suddenly, your computer, your internet, your home office, your travel, some of these become deductible expenses. You shift from earning gross income and spending after-tax dollars to earning revenue, spending pre-tax dollars, and paying tax on what's left. You can look at Roth IRAs as your mini hide phase. While not as flexible as PPLI, a Roth IRA offers the same core benefit, tax-free growth and tax-free exit. If you maximize your Roth contributions every year, you are building your own tax-free vault. You can learn about trusts and estate planning. Even if you don't have $100 million, a simple revocable living trust can save your family thousands in probate fees and months of legal headaches. You can start to think about how to pass assets to the next generation efficiently. You can understand that the game is played on a field you didn't even know existed. The financial industry is designed to sell you simple products, mutual funds, savings accounts, standard loans. These are profitable for the banks and easy for the IRS to tax. The complex products, the PPLI, the derivatives, the structured notes, are reserved for those who ask for them.
The first step to winning the game is realizing that there is a game being played. Most people are playing checkers, while the wealthy are playing 4D chess. By watching this, you have just been given a glimpse of the chessboard. The tax code is thousands of pages long. For the average person, it is a list of penalties. For the wealthy, it is a list of incentives. The government writes the code to encourage certain behaviors: investing in businesses, providing housing, buying insurance. If you align your money with what the government wants, they give you tax breaks. The wealthy are simply masters at alignment. If you want to keep peeling back the layers of this financial onion, if you want to know how the sausage is really made, and maybe how to grind some of your own, hit that subscribe button. We are going to keep exposing the blueprints of the 0.1% so you can at least try to level the playing field. We will cover more topics like how to use real estate depreciation to offset W-2 income, how to use leverage responsibly to amplify returns, and how to legally structure your life to minimize your donation to the IRS. I'm Peter Lewis. Remember, in the game of wealth, ignorance is expensive. Education is the only investment with infinite returns. It's not about how much you make, it's about how much you keep and who you hide it from. See you in the next one.